This is the third and final video in this series. I'm going to start off this one by summarizing what happened in the previous two, and then we'll go on to some new information, including how interest rates are affected, especially by the current monetary policy. Spending, printing, and debt are all interrelated. As I illustrated in Part 1, poor fiscal policy can lead to inflation and even hyperinflation. I will briefly review this again. Everybody knows that the more our government spends, the more indebted it becomes. This is because tax revenue doesn't come close to our spending. What most people don't know, however, is that some of the fiscal shortfall is paid for by printing money. The government does not do this directly, as I will explain later. However, the net effect is identical, and that is inflation. Inflation decreases the value of currency, including the currency loaned out by lenders. The interest on bonds and loans then increase to entice lenders back into lending. Higher interest rates mean higher service must be paid on any future debt. Since government bonds are mostly short-term nowadays, this affects spending within a matter of months. More spending leads to more debt leads to more interest payments, and as you can see, we're trapped in a vicious cycle. You're probably wondering why, if this is going on, are we seeing some of the lowest interest rates ever? Interest rates are determined by three things: the supply of loans, the demand for loans, and inflation. In an effort to stabilize the economy, the Federal Reserve is currently printing trillions of dollars and pumping it directly into the banks. In short term, this will reduce interest rates. In the long term, however, all this newly printed money will lead to massive inflation. Eventually, interest rates will rise to an equilibrium with inflation. At this point, we will be in a state of stagflation. The only way to get us out of this stagflation will be to do what we did last time, and that's to stop printing money. This will lead to a record increase in interest rates, far greater than those we saw in the 1980s. The high interest rates will lead initially to fewer people being able to take out loans to buy homes and cars. This will lead to a sharp and dramatic fall in housing prices, possibly the lowest house prices ever. Since banks have tens of thousands of these homes on their balance sheet, this will lead to a massive mark-to-market loss. This, combined with the inability to loan money, will lead to a massive bank failure and recession. In addition, the government will be forced to raise interest rates on Treasury bonds. You should all know where it goes from here. The more debt service, the more spending, and therefore the more borrowing and printing. This will lead to a vicious cycle, further exacerbating the situation. To give you some perspective on the fiscal situation, the debt service for 2009 will be under $300 billion. The deficit will be about $2,000 billion. Keep in mind the current deficits include defense, Social Security, Medicare, these enormous bailouts, as well as lots of other things. After 2009 ends, the national debt will be around $13,000 billion. Interest rates will easily reach 15% at some point within the next few years, but let's be optimistic and say it happens in 2010. 15% of $13 trillion is nearly $2,000 billion. Keep in mind, the deficit for 2010 would have to include all of the other fiscal shortfalls we had in 2009, in addition to this. Because of the nature of the relationship between these forces, many believe that a high rate of inflation, and maybe even hyperinflation, could quickly occur without much warning from the economic numbers. Unlike the stagflation that occurred in the late 1970s and early 1980s, we will not be able to escape from inflation today by borrowing money instead of printing it. Instead, the only option will be to do what many have suggested for years and just cut spending. As I explained in Part 2, cutting spending has always been unpopular, which is why the government budget rarely does anything but grow. Americans overwhelmingly agree that they want to keep expanding Social Security, Medicare, and have a strong defense, all while paying low taxes. It is undeniable that this situation is unsustainable. What's scary is imagining what it will take for this cycle to meet its end. During the Great Depression, many unusual laws and regulations were enacted in an attempt to restore our economy. This is likely to be repeated in our current crisis. However, like then, the results will be disastrous. In the 1930s, under Presidents Hoover and Roosevelt, government grew enormous and struggled to find revenue. Herbert Hoover enacted record tax increases on income and imports. The Smoot-Hawley tariff, passed in 1930, was the largest peacetime tax increase on imports in American history. This led to a retaliation in the form of import taxes in other countries, and therefore ultimately meant a reduction in United States exports. In 1932, Hoover doubled the income tax, raising the tax rate especially on the wealthy. Already we can see that our current president is following the historical example set by Hoover. Obama has increased income taxes on those he deems wealthy, and he sparked an international trade dispute by placing a 35% import tax on tires. Like the Smoot-Hawley tariff, this assault on free trade was met with threats of reciprocation in tariffs. If these countries follow through, this would have a devastating effect on our already vulnerable economy. When FDR took office in 1933, he continued to increase taxes and spending, but not before he issued an executive order to confiscate all privately owned gold. In total, 500 tons of gold were taken for private U.S. citizens. Based on these facts, it's logical to assume that when facing a severe enough recession, the government may again attempt to seize property in order to fund the ever-expanding government without having to inflate the currency. Historically, countries that have attempted to seize wealth from the wealthy end up experiencing what is known as capital flight. This is where rich people lead a mass exodus out of the country in an attempt to evade persecution. To prevent the wealthy from simply leaving, laws may be enacted to keep their fortunes here, and possibly to prevent the sale of certain types of property, like large homes, and to forestall high-volume stock trades. It should be noted, however, that our current crisis is very different from the one in the 1930s. Back then, the dollar was still on the gold standard, and therefore the government was limited in its ability to print money. That is no longer the case today. I believe that eventually, the rate and cause of inflation will be recognized by the media, political candidates, and most importantly, the American people. As Reagan identified the stagflation in the 1970s and ran on a platform to shrink government and curtail inflation, I believe that so too will the candidates of 2012 or 2016. Of course, the sacrifice endured by the people participating in the 1980s economy will pale in comparison to the sacrifices of our generation. In the 1980s, Reagan's government was cowardly and irresponsible. Instead of cutting spending and suffering the consequences, he was able to issue a record amount of debt and therefore defer his fiscal crisis to another generation. Unlike the 1980s, our government will not have the credit rating to issue as many bonds. Unfortunately, the elderly who rely on the government for support will suffer the most during this transition. After decades of politicians telling them not to save for retirement, America will finally wake up one morning and to find no government check in the mailbox. This will be devastating for those retirees who are no longer able to earn a decent wage. If we acted today on a campaign to taper off the citizenry from these programs before they disappear, it would drastically reduce the suffering of these people. I do not, however, feel this is possible under the current mindset. I'd just like to leave you with some closing thoughts. I'd just like to say that I am optimistic. I believe that regardless of our history, I think it will be politically possible for the necessary spending cuts to take place, but only after we slam into the tip of the inflation iceberg. Thank you. Please rate this video, and I hope you enjoyed it.